This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and revisit an old friend, IAS 2 inventory. You've seen inventory as an accounting standard in financial accounting, so what we're about to go through should be pretty familiar to you. If it isn't, don't worry, I'm sure it'll all come flooding back pretty much straight away. And then if there are any questions that appear within the exam, you'd normally find that these would be some of the easier marks to go through and obtain. Okay. So the key aspect in terms of the inventory is measuring the inventory at the reporting date. So remember, we need to process that closing inventory journal, whereby we debit the inventory on the statement of financial position, and then we credit the inventory within cost of sales in the statement of profit or loss. The issue is, what do we record the debit and what do we record the credit at? Well, remember, the accounting concept that we are looking at here is looking at prudence. And that prudence concept dictates that we therefore measure the inventory at the lower of cost and net realizable value. Okay. The lower because we don't want to anticipate any future sales, because ideally we should be selling the inventory at higher than it originally cost us. So therefore we want to recognize the inventory at its cost as opposed to that higher future selling price. However, if we have an incident whereby the inventory becomes damaged, becomes obsolete, and therefore its selling price begins to fall, and it begins to fall to a point whereby it becomes less than its cost, we need to be prudent in recognizing the loss on that inventory immediately, don't we? So therefore we're looking at the lower of cost and net realizable value. Remember, when we're looking at the cost and the net realizable value for our inventory, we don't look at the inventory in total, but we look at it on a line by line basis, looking at each different type of inventory that we produce or sell, and therefore valuing it separately. Okay, so I think in the earlier example, way back in the published company accounts chapter, when we looked at that example, did we have Trot? And was Trot there a manufacturer of cricket equipment? And we looked at, was it bats, gloves, and pads, or something along those lines? Okay, so we looked at each line item separately. Just a little bit to add to what we've seen previously. When we're looking at the cost and the NRV, we need to be specific about what we record as the cost and what we record as the net realizable value. So the cost is your purchase price, plus any costs that are incurred in bringing the inventory to its present location and condition. Because if you're a manufacturer, then you're going to buy in the raw materials. So you're going to look at the purchase price of those raw materials, including any non-refundable taxes that there may be. And then on those raw materials, you're going to subject them to a process. So there will therefore be some labor costs. There will be some factory overheads that will then be incorporated in getting that inventory into a finished goods condition, so that it is in the condition and location ready to be able to sell. So the costs that you're looking at there are your materials costs, your labor costs, and then those manufacturing overheads. Small point to note, and we'll see it within an example a little bit later, but when you're looking at your manufacturing overheads, we're looking at it based upon your normal level of output. So when you're working out a cost per unit and you've got those overheads in total, you don't base the overheads on the actual number of units produced, but what you expect to produce. Okay, going back to, if you like, your standard costing methods. In terms of the net realizable value, well, that's looking there at what we expect to sell the goods at. So your selling price. But then what we need to be able to go through and do is anticipate the cost that we might incur in the future. So in selling that item, we might have to make modifications to it to make it into a saleable condition. So maybe the cost to complete it. And then you might have some selling costs as well. Okay, do you incur any costs maybe in terms of advertising be able to get that item out there into the public domain, to be able to sell it, we need to deduct those costs of completion, those selling costs, to get us to our NRV. Once we've got the NRV for the product, once we've got the cost, we can then compare the two and go with the lower. Once we have the lower, we can then record the journal entry, debit the inventory on the SFP, credit the inventory on the statement of profit or loss within your cost of sales. There we go. So that's the background. I'm not going to go through and cover any cost formulae in terms of LIFO, FIFO, or weighted average. That's a topic that's exhausted to death, I think, within financial accounting. Yes, it could crop up within financial reporting, but in my experience, which goes back several years, I don't think I've seen it there in any detail in either an F7 exam, and therefore wouldn't expect really to see it within a financial reporting exam. But if you want to, by all means, go back and refresh yourself on FIFO, LIFO, and weighted average. Okay, so that's it from this section. In the next video, we'll go through there and have a look at the examples and putting into practice what we've just seen there. See you in a minute.